Hello, everyone, and welcome to the final class. I hope you guys can hear me, and I hope you guys can see my screen also. Can you hear me and see my screen, right? You can hear me, you can see my screen, right? Okay. Now let's begin. So today's class is just me summarizing everything that I've taught. I will start from the beginning class. Market structure, inducements, other blocks, breaker blocks, liquidity, types of liquidity, compiling everything together. So I'm just going to do everything in one session here, everything in one session. So let's begin. So I'm going to start from, I'm not going to start defining everything because this will be more of practical, so because I've already defined everything before. So like I said, this strategy is made up of three key things. That is market structure, our liquidity, then our point of interest. Market structure, liquidity, point of interest. Now, what is your market structure? Market structure is the current flow of the market, the current flow, the current behavior, the current condition of the market. That is what market structure is. Now, we have two market movements, two ways that market move. We have the trending market, and then we have the what? The ranging market. So we have the trending market. And then we have the ranging markets. So the trending markets, in the trending market, that's when you now have the two types of trending markets. You have the uptrend and then you have the downtrend. So here is where you have your uptrend and your downtrend. And then you now have your ranging market. So the market structure is the current flow, the current behavior, and the current order flow of the market. Then the two types of market movements, the way the market moves, we have the trending market, we have the ranging market. In the trending market, that's when you have your uptrend, and your uptrend is signified by markets making a series of higher highs and higher lows. That's when you can say that your market is on an uptrend, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. When you see this means that market is on an uptrend. Then for a downtrend is market making a series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. This signifies that market is in a downtrend. So this is the uptrend, and this is downtrend. Then for a ranging market is when market is consolidating between support and resistance. It's not going trending anywhere, just consolidating between support, resistance, resistance to support, support to resistance, resistance to support, support to resistance, resistance to support. This is what a ranging market is. So these are the three market movements: the uptrend, the downtrend, then the ranging market. The ranging market is also called the consolidation. What market is consolidating, and before this consolidation happens, this consolidation basically means that market is accumulating liquidity. So this is what consolidation is. So uptrend, the downtrend, and the ranging market. Those are the three market movement patterns. Now, what do I actually look out for in market structure part of my strategy? What I look out for, there are two key things I look out for. I look out for market structure shifts and I look out for break of structures. So for market structure shift is just an indication that the current trend is about to end and a new one is about to begin in the opposite direction. So what do I mean by this? So this previous structure I drew out here is clearly an uptrend. Here is an uptrend, clearly an uptrend. Is very visible because market is trending up. So this is what it means for market to be an uptrend. higher highs and higher lows, higher highs and higher lows. So that is what an uptrend signifies. So any deviant now, any kind of deviation from this particular pattern that market makes while being on an uptrend, just know that a structure shift has occurred. So the way market is doing higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, if market does something like this, comes here, makes a lower low here, then goes down, this is a structure shift. Understand? If market is making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, and makes a lower high and goes and it's a structure shift. And if it also does it to the opposite direction, so if he makes a lower high, that's a structure shift. And at the same time, if he makes um a what? A lower low. This is also a structure shift. Why? Because it deviated from the normal pattern that market follows when it's making an uptrend, when it's being on an uptrend. So any deviation from the current pattern that market follows for a particular trend, that is what a market structure shift is. It's an indication that the current trend is about to end and the new one is about to begin in the opposite direction. So the way the market is making higher highs and higher lows, higher highs and higher lows, higher highs, then comes here and makes a lower low. This already has a market structure shift occurring here because market already deviated from the current trend, from the current pattern it's following to make an uptrend. So this right here is a market structure shift. Same as if market is what on a downtrend and then deviates from the characteristics of it being on a downtrend. So for market to be on a downtrend, you can see it making lower highs and lower lows. That's the characteristics of market being on a downtrend. It's fixed. Lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. That's what it means for market to be on a what? On a downtrend. So if market now makes any deviation from this particular pattern, lower highs and lower lows, lower highs and lower lows, if it comes here and then makes lower lows, instead of making another lower high here to continue the trend, it now breaks past this last high, making a higher high. This signifies a what? Market structure shift. So market structure shift is just an indication that the current trend is ending. So for you to get a proper market structure shift, it has to change patterns from the normal characteristics of price being on a downtrend or on an uptrend. So only trending markets can have a market structure shift. Only trending markets. So if market is trending down and then the normal characteristics of market being on a downtrend changes, then that there's a market structure shift. And then for market structure shift, whenever it occurs, you take trades in the opposite direction. That's it for a market structure. Whenever it occurs, a market structure occurs, you take trades in the opposite direction. That is it. Now, that being said, like I said, I make use of two things, market structure shifts and then break of structure. So I've talked about market structure shift. Is one market deviates from the current trend and start preparing a new trend in the opposite direction. Then for break of structure is when market breaks a particular key level in price while still remaining in its current trend. So in structure shifts, if market was previously on an uptrend and shift structure, you're going to start looking for trades in the opposite direction. So if it was previously on an uptrend and shift structure, you'll be looking for sales. If it was previously on a downtrend and shift structure, you'll be looking for buys. Understand? So, but in break of structure, that direction that markets break structure to is where you're going to be looking for trades in. Do you understand? So, what do I mean by that? In structure shifts is for trends, but in break of structure is basically for mostly for ranging markets. You can also occur in a trend, but for break of structure, each zone that gets broken, we are going to be looking for trades in line with that current zone that breaks. So, for example, break of structure now, this is what break of structure basically means. The market is making higher highs and higher lows. This is higher high. Market pulls down, makes a higher low. This now is a new high in the market. That's a new structure. If market should go and do something like this is a break of structure. Market will now come back, make another low. If it comes here, this is another high here. If it breaks here, this is another break of structure. Understand? So as markets, whenever market does break structure, if you're taking a trade, you're still taking trades in line with the current trend. So for break of structure, you're trading trend continuations. Understand? But in market structure shift, you're trading trend reversals. So if market comes here also picks up this point of interest, this last high here, becomes another structure to be broken. Understand? So if market now still comes, breaks past this high, this is also a break of structure. Understand? So this is what a break of structure looks like. But for market to now occur a market structure shift, for a market structure shift to occur, let's say this was the last low, market will now come here and then breaks this low. This is not a market structure shift. So for break of structure, you're taking trades in line with the current trend. So for break of structure, you take buy here. If you push back, you take another buy. You understand? Another buy. But whenever this market structure shift occurs, you now start looking for what? Sales. You understand? So that's the difference between break of structure and market structure shifts. In break of structure, you're taking trades in line with the current trend. So because here is your resistance, down here is your support. So when market breaks any particular zone, you'll be waiting to take another trade in line with this current trend. Another way you can trade break of structure is when market makes, like, for example, a resistance zone and also makes a support zone. You understand? And the market eventually has been bouncing from resistance to support, and the market does something like this: higher highs, higher lows, higher highs, higher lows. Now does something like this, breaks past that resistance zone. That is also a break of structure. That is even more valid because it's a double break of structure. It broke this high here and also broke a resistance level there. So this is also a valid, very, 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 very valid high probability break of structure. It's the one that breaks two structures. It will break the first high and then break another high. So you broke this last high here and also broke this resistance level here. So that is a very, very, very high probability break of structure. You understand? So for market structure shifts, you're taking a trade in the opposite direction. For break of structure, you're taking a trade in line with the current trend and the zone that market broke into. That's the difference between break of structure and market structure shift. So that being said, I'll now move on to the next part of my strategy, which is the liquidity. Also, let me see if I can map out uh how about structure thing here? Okay. This is break of structure right here. This is a break of structure. Market being on an uptrend, higher highs, higher lows. This last high here now became a new zone to be broken. Once market broke past this zone, this was a break of structure. You will now take trades in line with this current trend. You understand? Then this last high here gets broken. That's a break of structure. You take trades in line with its current trend. You understand? So for each market is trending up, you'll be trading in line with its current trend. That is what break of structure is. For market structure shifts, market will change direction to the what opposite side. Let me see if I have a chart with a market structure shifts on it. For market structure shift, market will change direction to the opposite side. So if it was trending up, market will start trending down. I don't think I've taken sales in a while. Okay, this is it. So market was on a previous uptrend. You can see clearly market is making higher highs and higher lows here. This is it. Higher highs and higher lows, higher highs. Then it came here and did what? Broke this structure to the downside. This last low that market made there, it broke past it. This means that there was a market structure shift here. So that is the difference between a break of structure and the market structure shift. Break of structure, you'll be taking trades in line with its current trend. In break of structure, you'll be taking trades in line with its current trend. In market structure shifts, you'll be taking trades in the opposite direction. So break of structure is for trend continuations. This break of structure, this particular trade here, I took the trend continuations. I took more than 5 trades, like 5 different trades on the same setup. No stop. I didn't hit SL in any of them. I took the first trade here. It broke this high, retested another zone. I took another trade from here. It did another break of structure. Gave inducement, retested the break. I took another trade here. It broke structure, retested the break. I took another trade here. Straight, no. Let me see. No loss. This was the account. See, the first trades I opened up, there was no loss on all these your profits. The red was just withdrawal. Using just understanding one concept and then following it up. No loss on the account. And these were different trades. I didn't enter all these trades once. If you pay attention to the entries, you will see this was 196.425. The other one is 196.516. The other one is 196.472. This one is 195.702. This is 195.57. This one is 196.9. These are different entries using the same concept. catching the same trades, but different entries, just with understanding entries on that trending in line with the current trend. If I see a structure shift occur, I'll start trending in the opposite direction. But because there was just a break of structure occurred, I knew that market was going to be going in this current trend that is buying. So what is I'm now finding the pattern. If it breaks structure, you give me my inducement, I'll find my break, I will take my trade. Break structure, inducement, I find my break, I'll take my trade. So I kept taking buys, buy, buy, buy. You understand? So understanding the pattern that market is using to you know, understanding the pattern the market is using is very, 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 very crucial. That's the difference between break of structure and the market structure sheet. So let me now move on to the next, which is my inducement. So I've talked about market structure, that it is just the current flow of the market. Now, the next part of the strategy is what? Is inducement, is liquidity. Now, there are different types of liquidity, but the one I use for picking entries, like the one I use before my POI, is my inducement. You understand? There are different types of liquidity, but the one I use for picking before I pick my entries is my what? Inducement. Inducement is another type of liquidity. Inducement is basically just the first pullback, the first valid pullback that market makes after a structure shift or after a break of structure. That's what an inducement is. The first pullback that market makes after a structure shift or after a break of structure. For example, uh, let me use break of structures, for example. So market made a higher high, made a higher low. This is a zone for market to break, for you to confirm a break of structure. So if market now comes, breaks that structure, you understand? If it now does like something like this before it continues pushing up, this is what the inducement is. You understand? The inducement is a trap in the market. Market will eventually sweep that inducement to trigger the valid point of interest or something like this. It will now come, take this inducement out, trigger the point of interest, and then push up again. If it still breaks this high, this is where the break of structure is. You understand? Then it will still do what? Create an inducement, push up again, understand? Then come out and then trigger your point of interest. If it still goes and breaks this high, same thing again. This is a break of structure. You will now see your inducement. They will still come here, trigger your valid point of interest and push up. So this is your inducement. This is your inducement. This is your inducement. So the inducement is just right before a POI. So that's what markets will keep doing. Break structure. This is the break of structure here. Come here, create inducement, go up, and then trigger the main point of interest. It will keep doing this until, let's say, a trend changes. Market will now, instead of now making another higher high, it now changes to the downside. That's why you now know the market is now changing direction. If it's not changing direction, you now, for example, now take sales that will now go and clear this entire trend line liquidity here. So that's just it. So that is what inducement is. The first valid pullback that market makes after a structure shift or a break of structure. So the way that market did a broken structure here to the upside, you will see market make a pullback. It can be a week. The pullback can still be a tiny week before market push up. It can still be a normal full candle. It can be a tiny week, whichever one it is. As long as it pulled back towards the direction that market broke from, that is your what? Your inducement. You understand? So the inducement is a trap in the market. Is something that is a trap. It induces early traders, early buyers or early sellers to jump into the market and eventually getting stopped out and market will still go their direction. That is what your inducement is. So for a trend, if market is trending up and higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, it now does a structure shift to the downside. You will see market make a pullback towards the direction that it broke from. It can be a week, it can be a normal full candle, but it will pull back to that direction and then push towards that direction that it broke into. So either it sweeps the last high low that market made after a shifted structure, or it goes up to 50% of it, or becomes equal to it. So either it does something like this before coming to trigger the main point of interest. Do you understand? Or either it sweeps the last low that market made, or it will come here close 50% of the last move before coming to trigger the main point of interest and selling. Or it can also just be equal to it. It can also just come here and be equal to the zone, then go and trigger the main point of interest before going down. But it has to go close to at least 50% of where the last low happened. Like if it was a structure shift to the downside and market still short to the downside, if it pulls back, that pullback will also have to go towards up to 50% of the last low that markets made after a shifted structure. So this last low here, if market shift structure here pulls back, this next the pullback should push market down again, but pushing it down should be at least 50% of this last low that market made here. If the break of structure was to the upside here and market pulls back, the pullback should push market up again at least 50% of the last high that market made here, or 100% or past it. It should not be lower than at least 50%, because if it does not push it up to close to 50%, it just means that this is just a liquidity sweep and market may continue trending down to the downside. That's just it. So I've talked about the inducement, so that is the first valid pullback that market makes after a structure shift or a break of structure. Now it's time to talk about point of interest. Wait, let me mark the inducement on the chart. This is a clear example. Market did a structure shift, a break of structure here. This was a break of structure to the upside. This last high, market broke the structure here. So this was a what? Break of structure to the upside. After market broke structure, it did what? It made a full candle pullback. This is a pullback. This is an inducement, a pullback. So this is our inducement. And what it did do, it pushed markets close to 50% of the last high. Inducement. So that is the trap in the market, your inducement. Please hang on. Someone is calling my line, disturbing my network. Hang on, please. Someone is calling my line, disturbing my network. I'm coming. Just hang on. Someone is calling me and disturbing me. Some people don't get sense. Someone calling my phone. Just hang on. Can you hear me? Can you hear me? And can you see my screen? I don't understand why people. You have my WhatsApp number and you're calling me on direct call. Can you hear me? Can you see my this? Can you see my screen? Okay. So, like I said, your inducement can be a retracement. People saying it's retracement, no wahala, whatever thing it is to you, as long as it's a pullback towards the direction that market broke from. So this is your inducement. So the break of structure, you will see your inducement. So this is just the first valid pullback that market makes after a structure shift to a break of structure. That is what your inducement is. Same thing here for this trade that I took here. This particular trade that I took here was off of a breaker. This trade. And where did I get the inducement? This is my breaker here. But where did I get my inducement? I'm going. Okay, yeah. So market broke to the upside. After breaking to the upside, it did what? It made this pullback here. This is the candle, my inducement candle here. That was where I marked my entry. After market did this pullback, it went up above 50% of the last move. It even went more than 100% of it. So I knew that that was a valid pullback. Then I marked this entry, my breaker. Understand? This particular trade. Let me see if I can still find this particular trade. I'm just teaching everything from beginning again. I've taught it before, but I just want to do everything in one class. So this was the trade. So as I'm teaching, I'll be showing, understand, evidence, show evidence that you practice what you teach. You just don't teach it. So this trade now, this was it. This was the break of structure, the inducement. Then this was the trade here. Understand? So is this particular trade right here? Let me see if I can find the execution. Is this the trade? This particular trade here. It was more than 4,000, just that this was where I took the screenshot. So it was this particular trade here. This is the before, this is the after. So structure shifts, inducement, breaker. That was my entry for this trade. So as long as you follow this strategy, and most people don't zoom out. Did anybody pay attention to the time frame I took my entries from? 30 minutes time frame. And most people don't shrink out there. You see someone just come out, zoom their chart in like this. They'll zoom it in. This is the only thing you'll be seeing on their chart. They will not pick this other block here. Next thing, they already carry screenshots, send it for DM. I took a loss on this trade and I would like to know why. You like to know why you never shrink your charts. You have not gone to the left side and see where market is reacting from. If I started taking buys on DJ, I already saw that market was reacting from this other block for a buy. And for me to take my profit, I have to push market close to at least here to get to this liquidity zone. That was why I was focused taking buys. But these people, market is selling from here and they'll be looking for buys from this other block here, this other block here. They're not paying attention to where market is reacting from. Then they will not take a loss. Next thing you see your DM is how far I took a loss on this trade. Let me do this one, do this one, do this one, do this one. They have not, most people don't even back test. And I don't like lazy people. Most people don't take time to back test. You see someone take a loss on their, you see someone take a loss on a trade, they will not actually go to their trading view, open their trading view, zoom out and see if they cannot go out and zoom out and see if they made a mistake on their chart. They will just take out and send it to you for you to, you teach them, you tell them their mistakes, you even give them signal to trade. That's what some people want. But they can never take out their charts. Okay, I took a loss on this trade. Why did I take a loss? You cannot zoom out and see, okay, is market react? I'm taking a buy. Is market selling? What's the general trend of the market? Is the market reacting from a point of interest where you're supposed to be selling from? They don't want to take that time to actually analyze themselves. They want you to hold them and do everything for them. That's why most people, I look at their charts, they will send this setup and think they made a mistake, and they will only show you that part of the chart. They're not going to zoom out the chart. So on higher time frames, someone on 5 minutes time frame, 10 minutes time frame, 15 minutes, they will show you the particular trade that took a loss. They will not check 4 hours to see if market is selling. I will not tell them, okay, check 4 hours time frame. They will not switch. I'll be like, oh, I've seen my mistake. But they could have easily done that before, prior to the to showing me the loss that they took. They could have done that before, but they won't. So if you're trading, trade in line with what the higher time frame trend is saying. Do you understand? So trade in line with what the higher time frame trend is saying. Don't just come out and take a trade out of nowhere and then start finding faults in your trade. The strategy will work, but make sure you're taking a trade from a higher time frame point of interest, not just from a lower time frame point of interest. If you're taking buys, make sure that the market is buying. You understand? Even structure shifts that happen to the upside. For example, if market is on a downtrend and then there was a market structure shift to the upside, before it can happen, there's always a zone that market is reacting from. Paying attention to this chart, you can see there was a break of structure to the upside. But before this break of structure to the upside happened, market was already reacting from this other block here that was supposed to push markets up. So if I'm taking a market structure shift trade to the upside, I'm still taking it in line with its current trend, knowing that market is reacting from a point of interest where I'm supposed to be taking buys from. Do you understand? You cannot just come out and be taking buys when market is not yet buying. You cannot take buys from a market when market is not buying. You have to make sure that you're taking buys when market is bullish. You cannot be taking buys when market is bearish. So before you can actually start analyzing, check the general trend of the market first. Understand the general trend. If you want to understand the general trend of the market, then you can trade in line with this current trend. If market structures occur, make sure that if, for example, if market was previously selling and then you now see a structure shift to the upside, first of all, trace where that structure shift is reacting from first. Yes, there was a structure shift to the upside here, but before it occurred, where did the market stop last before it started that structure shift to the upside? If the zone is reacting from is not a valid point of interest for reversal, don't trust that structure shift. For example, this here, market broke this high here. Most people will taking this as a what? As a break of structure. But which zone is the market reacting from? It's not reacting from any point of interest where market is supposed to be buying from. So this is an invalid trade. This is actually a liquidity sweep to trigger this breaker block and market continues selling. But once it occurred here, I trusted it here. Why? Because I traced where the reaction was from. And where I traced it to was this other block here that market was actually supposed to start reversing from. So before you actually start marking out identify the general trend of the market. Where is market reacting from? It does not take time. If I come out here and I see my chart here, this thing I will do is just to zoom out my chart, look on higher time frames. This is this thing I can do 4 hours and see this buy that's occurring here now. This buy that market is buying here. This buy here. I will look at where market is reacting. So, for example, if I bring out my tool and I mark here, that's why you see this long line. A market can be reacting from a support zone here. I can see, okay, this is a support zone. It can be a valid zone where market can start pushing up because it's a support zone. Or market is reacting from another block. That other block here can be a valid zone that market may start pushing up from. Once I've gotten it, that's when I can now start going to 15 minutes time frame, 5 minutes time frame, and now start looking for structure shifts. That's when you can now get a value structure shift because already it's reacting from a zone where market is supposed to push trades up. And then I will now be buying in line with this current reaction. I'm not going to be taking buys here when there was no zone where market was supposed to be reacting off of here. This is just a temporary pullback. So before you can take trades, it does not take time. Most people are just lazy. Can't you just go to higher time frame, 4 hours? That zone that market is reacting off of now, is there any valid zone for market to cause a reversal? Is there an order block, a valid support zone? Is there a valid breaker block? This place the market is reacting off of, is there any valid zone that's supposed to push market to reverse? If there's a valid zone, that's when you can now come down to your lower time frames and then now start looking for your market structure shifts, your inducement, your order block, just like this one now. You see, market was reacting from a support zone here. The support zone that market was reacting off of here that I just marked out, said there's a valid zone. That's when you now see markets making lower highs and lower lows, lower highs. You now did this structure shifts, did this inducement, pushed up, now came down to trigger this order block. That's why you now see this buy happening. And this is a valid buy. Do you understand? So before you do anything, can't you just zoom out, just zoom your chart, go to higher time frames? This is an order block just because it was reacting from the bottom, but this is an order block. It can be a zone that can cause a reversal in markets. After you've gotten trades, that's when you can now go to lower time frames and now start looking for your structure shifts, your inducement, your break of your order block. Don't just come out, look on the chart and be like, yes, structure shift. Where are you taking a trade off of? Is there any valid point of interest where market is supposed to reverse from? It does not take time to analyze. If you zoom out your chart to 4 hours, 1 hour, 2 hours, see where market is reacting off of first. Once you've seen that, if it's a valid zone that market is actually supposed to buy from, that's when you can now start looking for buys in that direction. Don't be looking for sell. Most people now tell me, like Michael told me the other day, now come and tell me that he took a trade from this breaker and he hit his SL. And I asked him, where are you selling the trade to? Where are you selling? This trade they're selling now, where are you selling it to? Because the zone you're selling it to, market already tapped into it, and that zone is a reversal order block. So why are you selling trades down to another block that market already tapped before for a buy? Do you think it's going to respect it? Don't just come out and look at 5 minutes. If you look at 5 minutes, most people will say structure shift, inducement, breaker. I will take my trade there. If it fails, they will not start looking to blame you or to blame the strategy. But if someone that now uses technical analysis, because it's logical thinking, will come out first and zoom out. Oh, I can see another block here. Market may probably be reacting on this other block to push price higher. Even if it does not get all the way here, but it will push markets up. Okay, I've gotten this now. What do I now do? You now come to your 15 minutes time frame. Okay, if I pay attention to my 15 minutes time frame, I can see what lower highs and lower lows the market is making. After market hit this entry, what did it do? It now pushed up, created this zone and broke this structure to the upside, made the inducement, and already reacting from this demand zone here. That's when you can now start taking your buys from where? This zone. So you cannot start taking your buys from this zone. So technical analysis is more than just coming out and drawing. There's logical thing. That's why you see me. I don't draw more than 2 lines on my charts. I just observe where market is reacting from and I find a way to jump in. So most people don't. I don't know if I will call it lazy or most people just don't. I don't know. They feel like once they paid for mentorship and you've thought if they don't start seeing this, they don't know they have to put in their own efforts. Me, once I've seen that reaction, I saw this structure shift, I saw this inducement. This is where I can now take my trades, leave my stop loss here, and then probably target this last high or target here. Simple trade. Simple, very simple trade. The only thing I did here was just go to 4 hours time frame. After I went to 4 hours time frame, I saw that it hit a zone for reversal. I went to lower time frame, 15 minutes, saw the structure shift to the upside, saw the inducement, market tapped into this other block zone. Simple. I took my trade. Did I spend more than 1 hour analyzing the chart? Did I spend up to 15 minutes analyzing the chart? The only thing I just did here was to go to 4 hours. Then I went to what? 15. After going to 4 hours, saw where market is reacting off of. I went to 15 minutes. This was the only thing I did. It's not magic. I didn't stress myself doing anything here. But if someone open this chart, oh, structure shift to the downside, oh, breaker, they'll take a sell. They don't want to zoom out their charts and go to other time frames. That's why sometimes I get tired replying the charts because it's the same mistakes over and over again, the same repetition over and over again. They don't want to scroll out their charts. So when I was teaching the strategy, people were saying, oh, they don't want to, I don't understand most people, they don't want to calm down. So when I was teaching the strategy, when it was still fresh, most people were expecting to be hitting TPs back to back. I've not even finished the strategy yet. So now that I'm done with the strategy now, and I'm telling you guys the backbone of what you're not going to learn everything in one class. First class, introducing the strategy. Second class, breaker blocks. Third class, other blocks. Liquidity types. Now I'm not telling you guys what you know. That's where market is reacting from. If you go to 4 hours and see that market is bullish, that's when you can now trade in line with market being bullish. If you open up the charts, go to 4 hours, 1 hour, 2 hours, find out where market is reacting from first before you can now start taking trade. This GJ that I took here, this trade that I took here, this trade that I took here, I did not take this buy just because I felt like taking a buy. I took this buy because on 30 minutes time frame, market was buying from a 30 minutes order block. So I knew that I would just be taking buys for now. No need to take sales. We see most people taking sales from this breaker, this breaker, this breaker. Any pullback they see, they'll take it as a sell. But I knew that market was reacting from a 30 minutes order block that was supposed to push markets up. So I'm going to be looking for only buys. Understanding the general trend of the market is very, very, very crucial. So it does not take time. The only thing you need to do is just zoom out your chart. It does not take time. Zoom out your chart. For example, when market was reacting from this other block here. Sorry. When market was reacting from this other block here, from this breaker block here, that was what pushed markets up. Do you understand? So anyone taking a trade from maybe trying to sell from here will be taken out before market now goes to another zone for sale. So there are zones that markets react from. The left side is for you to study reaction. The left side of your chart, for example, market will react here. It will react here. It will probably also react here. Do you understand? And it will also react where from this other block here. So you have to first of all open up your charts, go to those higher time frames like 4 hours, 2 hours, 1 hour. Once you've gotten that, wait for market to now come to that point of interest. That's when you now start looking for 5 minutes time frame structure shift to the upside, liquidity inducement, and then breaker block or other block. You don't just come out of nowhere and start picking it. You pick it when it's reacting from a point of interest that's supposed to push market in your favor. If you're taking a buy, look for where the first reaction of that market, for example, the first place the market started pushing from. For example, on this 15 minutes time frame now, on this 15 minutes time frame, if I mark with that's the only thing you see me marking with my straight line. This straight line that I always use, I'll just put market here. Once I've marked it here, I switch to 4 hours or 2 hours. I'll look for where the reaction is coming from with this straight line. If where the reaction is coming from is a valid point of interest, for example, this now is another block, you understand, for a buy. So if where the reaction is coming from is a valid point of interest, it's supposed to cause a reversal in the market, that's when I now start looking for what? Structure shifts, liquidity, point of interest after is a valid zone for a reversal. Do you understand? So it's really simple. Higher time frame, then lower time frame. Higher time frame. My screen is not showing. My screen is showing now. Can you guys see my screen? Can you guys see my screen? About it's saying I can. Seeing my screen is showing now. And my screen is showing now. Some can see my. Most people are saying they can see my screen now. Let me stop sharing and share it again. You guys can see it, right? You can see it now, right? Okay. So first of all, go to higher time frames, find out where that reaction, that move that market is making, find out where the reaction is from. If it's from a valid point of interest, the market is supposed to reverse from. So most people now would have been taking sales from this breaker. They will get stopped out. Say, next thing I don't see from this thing. If I took a loss, what happened? No one is looking at higher time frames. No one is looking at higher time frames. The thing they will not start telling you is there was the structure sheet to the downside. Look at it now. The structure sheet now. What if Michael won't use Kimi that day now? The structure sheet to the downside. This is a structure sheet now. And I asked him, where are you selling the trade to? If you're taking a sell here, where would you sell this trade to? Now you want to sell it again to the other block that market is already the market already mitigated. So understanding the general trend of the market is very, 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 very important. It does not take time to analyze. It does not take time to analyze. Understand? Just the only thing you need is higher time frame direction. If you're seeing higher time frame direction, no problem. Lower time frame for entry. The lower time frame is that one is now when you now start looking for what? Lower low, lower highs, lower low, lower highs, shorter shifts, inducement, breaker, or other block. That's just it. Higher time frame is just to see the reaction, where market is reacting off of. Is it reacting off of a high resistance level? That was still how I traded BTC, I think, yesterday. There was WC trade I took yesterday. I'm trying to look for it. Um, I think it was this trade. But when I took the trade, where is it? When I took the trade, this was where market was reacting off of. It was reacting off of this support zone down here. So I knew that market was going to make at least a push to the upside because I saw that support zone. Let me find the exact trade I took. I want to find the exact here. Let me analyze it again. I took this inducement here. And then I took this other block. So this was the trade I took yesterday. I later adjusted my TP to this draw on liquidity here because I knew that market was not officially bullish. This was about 3,000 pips that I did. I took my TP here. This was the trade I took on BTC yesterday. Let me see if I can see the before. This was the before. So I did not just take this trade out of nowhere because most people would ask, why didn't I take from this other block here? Because there's another other block here that market broke. But the place that market was making that reaction was not a zone for reversals. When I looked on the higher time frame, when market was still there was no conviction that market was going to reverse there. Because on my 4 hours time frame, there's nothing for market to reverse off of at that zone. But when I looked at market here, on the 4 hours time frame, market was at a good support zone. And if market comes to support, it must bounce off of the support first. There's what we call logical thinking in trading. You don't just come out and trade out of conviction. You have to trade off of logical thinking. Market bounces off of support, market bounces off of resistance. There's always going to be a reaction at any of those zones. So at 4 hours time frame, when I looked at that trade, I saw that market was at a support zone, and market would at least bounce off of that support to target another liquidity before you can continue selling if it would. That was I got my structure shift to the upside here. I got my first pullback, which is my inducement. I took the other block trade here. This was the before. This was the after. So first, please and please, I'm begging. Look on the higher time frame. I beg. I beg. Do not take time. Open chart. Look higher time frame. If you look on your higher time frame, it will now give you a direction in mind to where market is going to. A daily support or a daily order block that's supposed to cause a buy. Why are you still looking for sales? That time frame, market is at a daily zone, or 4 hours time frame is at a 4 hours order block where market is supposed to be causing sales from. Why are you looking for buys? First of all, higher time frames to know the direction that market is giving you. Then lower time frames to now start looking for your structure shifts, your so like why I had this class to just summarize with this thing. There was no point again going to breaker blocks and other blocks because I've taught them multiple times. If you need that, just go to the second video. That's where you catch it. So this class I want to tell you people what to look out for first. Higher time frames is crucial. Higher time frames. Most of you guys take trades from check higher time frames first for clear direction. You will not be taking losses like this. If you open your chart, you'll not be looking for any sales. 4 hours will tell you, or 2 hours, 1 hour, sometimes 30 minutes. Just shrink your chart. Look for that reaction you're seeing reacting. It's going to be reacting from somewhere. Where is it reacting from? Okay, it's reacting from this zone. For example, this chart. Okay, see. Just this is very clear. Where is he buying from? You can clearly see that he's buying from another block here. He's buying from another block here. Since he's buying from another block, will you not be taking sell from this? No, you will not. It makes me not even take this by itself. Because I don't the way BTC to make me reach 100k. And now why they take this class, they don't invest me because I mean they make 10k, I be 12k from this trade. When market data go collect from me, especially the way my market reach 100k. And if you reach 100k, go punish them. Because now wait think because they invest me. I was on the buy to go to 100k, but markets did not have enough liquidity to take my trades to 100k. This my profit was supposed to be around 20 something k, 30k at that TP safe. That was why I did not close this trade that day. So I knew that market will still come out and then hit a zone again for buying. So now the market is buying from this other block. So pay attention. If I opened up my charts, you understand, and I saw what market was buying from this other block, what will I be doing throughout that entire day? all I'm going to be doing what is buying. So as I've seen this conviction down here that there's another block on the 4 hours time frame that market is buying from, that's when I can probably now go to 15 minutes time frame. If I go to 15 minutes time frame and I start looking for what market, this is the reaction. Market now did what? Broke this structure here. And then this pullback now reacting off of this breaker. That's when you can now probably take what? A trade from this breaker block here. You understand? And now start targeting markets to go up. You understand? So just a little conviction of market is already reacting from a what? A buy POI, which is what? A 4 hours order block. That's when I can now take a trade. If I wake up tomorrow, all I'm going to still be looking for is buy on BTC. There's no point looking for sales on BTC because on 4 hours time frame is reacting from a 4 hours order block that market is supposed to be buying from. So that's why you now be looking for buys. See, there was a structure shift to the upside here. You will see your inducements here. You take a trade from this breaker block. This is a breaker block. My market is to react from the body of this breaker. Take a trade from this breaker block. Buy. You understand? You see another conviction again. Market is, you just keep buying because what? You've already seen on the 4 hours that BTC what is now bullish. So before you do anything, just open up your charts. It will not take time. I beg, Michael, please open your charts. 4 hours, 2 hours. Observe where market is reacting from. Okay, it's reacting from a 4 hours order block. It's bullish. There's no point taking a sell from this breaker block, Michael. This breaker block here, you're not going to take a sell from it. Market will disrespect it. Understand? Michael, this breaker block will still there here. There's no point taking a sell from this. Just be taking buys because why? On your 4 hours, market is now bullish. So higher time frame convictions, just to understand the direction of the market, then lower time frame for entries. Simple as that. So please, any question? For what I've taught me, my neck, don't they pain me? Which one is how do you know the zones that market will react off of on the higher time frame? Ah, God, my neck. On higher time frames, you look for what? Support zones or resistance zones, other blocks or breaker blocks. There's going to be something that market is reacting off of. Those point of interest that you normally use for your buys, that's just it. That's just it. Other block, breaker block, support resistance zones. There are zones that markets will actually push off of. You understand? Any question again? My neck is like paining me. You understand? So that's what I wanted to teach you guys. And that's always my fourth class summary. My fourth class summary is just to tell people this. And in fact, this November class, I taught this November class well more than other classes because even the types of liquids that I was teaching you guys, the ranging market liquidity, I did not teach other sessions. I had to go and paste in the video to watch because I had to just take time for this November people. And I think it's because of Michael. As you get us ask me question that day, my brain just burst. Or that one and story for another day. So just I will please just the more you include higher time frames, I think you will make less mistakes and you will be correct with your structure shift, your inducements. You see the clause on the breaker or on the other block, but you've not checked and seen the market is reversing from a higher time frame point of interest. So first of all, observe any reaction that market has made. If you open your charts and market is buying, just go to 4 hours or 2 hours, put a straight line on that buy that market is making, where the market started buying from, that push, put a straight line, go to 4 hours, 2 hours, observe where the reaction is coming from. If it's a valid zone for reversals on higher time frame, that's when you can now trade in line with that current trend. You understand? So one more, that's just it. I have one massive headache like this now. So that's just I know I don't even feel like I know I covered everything now. Like I've covered everything now. Everything. So that's just it. I know people were ready to start asking questions. That was why I took my time to cover every single thing I could cover because I don't know what you want to ask me again. So that's just it. What I'm under the market. But first of all, fund the demo account. Eh? With what you've learned so far, trade a demo account for like 1 month or 2 weeks. Fund an amount that you can that's realistic for you to fund. If you be Pablo, we get like that can actually fund $10,000. You can fund a $10,000 demo account. If what you are okay with funding is $100, fund $100 demo account. Write down round down a percentage risk. If it's 10% per trade, trade like two times in a day. You understand? Trade 3 days in a week. Then have a particular risk, can be 10% per risk, per whatever amount is on the account. Trade it for like a month. Once you've gotten enough conviction that you are profitable on that account, don't jump into a real account until that your demo account, you've gone like 2 weeks in profits on it. That's when you can now fund your real account. So that's just it. Oh, you guys should enjoy yourselves. I'll send the recording to the class. Please, no one should come out and start asking me for the recording. I will send this when it's done processing. Uh, right.